Right now, market sentiment is defined by a singular conviction. The artificial intelligence and semiconductor boom will continue driving indices higher indefinitely. This confidence has led to extreme institutional crowding. Momentum stock exposure, the measure of how many traders are chasing the same high-performing names, is currently sitting in the 92nd percentile. To find the breaking point of this trade, we track two metrics: the U.S. Momentum Index and its 30-day realized volatility. Usually, momentum rises as volatility stays low and predictable. This chart shows that at the 65 level, the relationship between momentum and stability breaks. When volatility spikes alongside a rising momentum index, it indicates that the stocks everyone owns are becoming erratic. In 2000, 2008, and 2020, this specific intersection marked the exact moment the market reached an unsustainable inflection point. Today, realized volatility on that same momentum index has reached 63.9. We are now seeing the same levels of price instability that characterized the dot-com unwind and the global financial crisis. Historically, when volatility rises this high within a crowded trade, it triggers a race for the exit as institutions try to liquidate the same positions at the same time. The data suggests the current market has reached a structural limit. When everyone is positioned for the same outcome and the price action turns violent, the trend is no longer supported by capital. It is vulnerable to a total reversal. A hidden battle is currently taking place between equity prices and the VIX, the fear gauge. Right now, the VIX is acting as a rigid, invisible floor that prevents the market from climbing any further. Typically, as stocks hit new highs, volatility drops, but recently, every time the S&P 500 attempts to rally, the VIX hits a hard floor at 16 and bounces upward, refusing to allow a deeper sense of market calm. On this split chart, the disconnect is clear. While the VIX repeatedly strikes the 16-point floor, the stock index fails to regain momentum. Each rally sets a lower high. These converging lines form a symmetrical triangle, showing a market running out of room. Because the VIX refuses to cross below 16, the math dictates that the only way for the pressure to resolve is for stock prices to break lower. This failure to push volatility lower proves that the buyers have exhausted their ammunition. The market has the structure of a rally that has run out of fuel. We can see this exhaustion in the actual hardware stocks that underpin the AI trade, specifically in the global semiconductor sector. South Korea's Kospi Index is the primary bellwether for tech hardware. If the AI boom were still expanding, we would see consistent upward progress here. Instead, these hardware sectors are experiencing massive, erratic price swings that result in no actual gains for investors. Look at the relationship between the Kospi and the U.S. Semiconductor Index. Over the last month, both have suffered through extreme vertical volatility, but the net overall progress flatlines horizontally. For professional asset allocators, high volatility paired with zero net progress is a major red flag. It indicates the AI rally has moved from a growth phase into a phase of pure instability. While tech stocks dominate the headlines, the entire system is being propped up by an external financial mechanism, the Japanese yen carry trade. For years, the yen has been the world's cheapest currency to borrow. Investors exploited this, shorting the yen to fund aggressive bets in high-yielding assets. This cheap money from Japan has been funneled directly into U.S. momentum stocks, providing the liquidity needed to push tech indices to record levels. But the Bank of Japan is now intervening to strengthen its currency. By forcing the yen higher, they are destroying the profit margins of every trader who used the yen as a source of cheap leverage. As the yen surges, it triggers a wave of margin calls. Traders who are losing money on their currency short are forced to sell their most successful positions, U.S. tech stocks, to cover their debts. The U.S. AI rally is heavily dependent on this borrowed Japanese capital. As the Bank of Japan forces that money back home, the liquidity supporting U.S. tech stocks is being violently recalled. These three threats are now overlapping. The volatility floor is holding, semiconductor growth has stalled, and the yen carry trade is rapidly unwinding. At the same time, institutional crowding remains at historic extremes. Because everyone is holding the same AI and momentum stocks, there is no one left on the other side of the trade to buy. When Japanese margin calls force a mass liquidation, these funds will all be trying to sell the same stocks at the exact same moment. This creates a liquidity vacuum. When selling pressure hits a crowded market, the number of buyers can drop to zero in seconds. As prices fall, volatility will naturally spike. This triggers automated selling algorithms that are programmed to exit the market when volatility hits certain thresholds, accelerating the downward move. A market defined by extreme crowding and high underlying instability is structurally incapable of a slow decline. When the sell-off initiates, the exit door will be too small to accommodate the sheer volume of capital trying to leave.